driving deflation. We've had it for 30 years. There's been a secular use of progressively lower rates. Guy Johnson mentioned it earlier. And it's taking income out of the system. That's what people don't understand. We're looking for credit creation that's not happening. And meanwhile, we're taking money away from grandma, and we're surprised that demand is weak. I think we need to rip up the script, if you will, in terms of economics and stop thinking with this neo-Keynesian construct because it's wrong.
Welcome to the Power and Market Report. I'm Albert Liu. My guest today is head of research at Kroll Bond Agency in New York. He's the author of the 2010 book, Inflated: How Money and Debt Built the American Dream. His new book project, entitled Ford Men, a study of Ford Motor Company and the Ford family, will be out later this year. He's a regular contributor to Zero Hedge, American Banker, and other regular publications. And you also may recognize him from his many regular appearances over the years on CNBC, Bloomberg, Fox News, and BNN. It's my pleasure to welcome Mr. Christopher Whalen to the program. Chris, welcome to the Power and Market Report. How are you?
Oh, doing great. Another day in paradise, right?
Another day in paradise. You know, a lot of people will recognize you from mainstream cable news, maybe less so online. For anyone who hasn't come across your work before, let me quote something you have on your personal website from George Orwell. It says, "The real division is not between conservatives and revolutionaries, but between authoritarians and libertarians." You sound like my kind of guy. You want to tell the viewers just briefly who you are and what you do?
Yeah, well, I'm a writer and an investment banker living in New York. I've been, on Wall Street for 30 plus years. Had my own firm for a while that was focused on bank analytics, and joined Kroll a little over 3 years ago. I'm responsible for the bank team, our new insurance group, and also sovereign ratings, which we'll start publishing at the end of the year. And then when I have time, I do macro research. I've got about 30 plus people in my group now, and we're growing very fast, in part because we're willing to rate smaller banks, regional and large community banks, which has been a very nice area of growth for us.
Okay, so it wouldn't be a good question for me to ask you, say, like in 5 seconds, give me your take on Monsanto, JP Morgan, and Apple.
Well, no, we're just poor credit analysts. So, I can always comment on operational aspects, but I try and avoid stock recommendations for obvious reasons.
Yeah, and I love to see it when you bond guys go on the mainstream, because you're real straight shooters, and I know I'm going to find out whether a company's making money, their balance sheet is intact and so forth, and not so much a wild guess on what the revenues are going to be 2, 3, 5, 10, or in the case of some companies, 50 years from now.
Well, that's right. Credit's about getting paid.
Right.
So.
Okay, let's go back a while, because you were one of the guys, the few, who recognized what was happening in 2008 and before, leading up to it, and actually warned your clients about it. And I'm wondering, can you go back to that time and talk about specifically the things that you saw that gave you concern?
Well, sure. It's interesting. I'm doing our next credit outlook right now, and I'm staring at credit metrics for residential mortgages and multifamily real estate, which are kind of where they were back in 2004 and 2005. What we saw back then was that credit had no cost. In other words, default rates were very low, and if there were defaults, they oftentimes resulted in no loss. You had banks like Countrywide and Washington Mutual reporting negative charge-offs, which means they recovered more than they lost. That's not a normal market. These are big portfolios, and people die, other things happen. You would expect to see some cost from credit. So what we saw in that period, and you see today because of the Fed, is that asset prices have been manipulated. There's a strong bid for these assets, so that even if, for example, a shopping mall defaults, somebody shows up and buys the loan at par. So the bank doesn't lose any money. They just want the asset. And you're seeing a lot of this type of behavior in other asset classes as well. So the background for this and the reasons for this are different today than they were 10 years ago. But it's interesting, when you see indicators like this, you know that you're at an inflection point. You know that you got distortions in the market, and eventually we're going to have to revert back to the mean. So, I think it's very similar to what we saw a decade ago, ironically.
Right. Now, do you think it's better or worse in a way? Because certainly there's been some reform, and my feeling is that we're looking pretty much at the same thing, but maybe this time the victims will be different?
Well, we've had reform, but it's a piecemeal effort. Some of the reforms were very necessary, like we needed to have a national overlay for doing foreclosures instead of relying on the 50 states. That was a mess. And so we did that, but we went too far. We've made the cost of servicing a loan so high that nobody wants to do it. We have a liquidity crisis right now in the market for Ginnie Mae, Fannie Mae, Freddie Mac loan servicing because the returns are negligible and we can't raise capital to support the industry. This is a problem. So I think a lot of the regulation, unfortunately, Henry, has constrained growth at a time when the Fed and the other central banks are trying to get credit creation to increase. We're doing exactly the opposite. And it's because we have this very piecemeal, very uncoordinated effort when it comes to regulation. And it's as simple as just getting all of the relevant people in the room in Washington and saying, what do we want? What's our objective for regulation? So I think, yes, the victims will be somewhat different. But if you look at, for example, what we're doing with banks, we say, well, you need more capital. You can't do those bad things you did last time there because we're going to make you hold more capital. What we're really doing is punishing the victims. We're saying, we won't prosecute the people who were responsible for acts of fraud, but we're going to punish all of the shareholders until they make those people behave. That's effectively the model that policy is following. And I get into very interesting conversations with Anat Ahmadi and a lot of the other researchers in this space. And they say, well, Chris, what else are we going to do? And the problem is that when you raise capital requirements for banks and other companies effectively, you're reducing growth. You're reducing job creation and everything else. So I think part of the reason we're seeing such disappointing numbers in terms of jobs and GDP growth and income is that the backlash from the crisis has been very severe. Elizabeth Warren, for example, and they keep just pounding away on the banks. But the banks weren't the problem. The bankers were the problem.
Yeah, and that's interesting you say that. So if the banks are being required to hold more capital, essentially being chased out of certain markets,
yes,
yet we still see the sort of the same symptoms of a problem going on. Someone is lending money into this space. Who has jumped in? Like when you say it's much the same and you're concerned, who has jumped in? Who is at risk here? Because it looks like the banks are much safer credits than they were before because they've been chased out of a lot of these markets.
Well, they are. You're right. They've been turned into ersatz utilities. They can't trade their own account because of the Volcker rule. For one way or another, I think there was a lot of merit to what Chairman Volcker did, but he didn't go far enough. If you're going to say to the bank, you can't trade your own account because of conflicts, obviously, I think at some point you got to divide the house and say, here is a bank that takes deposits that doesn't trade for its own account. But then meanwhile, over here, we need a muscular, well-capitalized broker-dealer who can do securities business, who can take risk for their own account for clients, and just completely separate them. Because to lock all that capital up inside of JP Morgan now actually results in less liquidity in the market. If you go back to the London Whale and that whole scandal about the way that they were managing the investments of the bank, it was a fiasco for months. What was really going on there was that the lawyers had started to shut down the active management of the Treasury at JP Morgan because they used to make markets around their bond investments. They would make a buy-sell market in everything they owned. They don't do that today. So that entire book today is passive. Nobody trades it. And there's now less liquidity in the market as a result because that capital has been segregated over here and you're not allowed to take risk with it. I think that's a problem. I think one of the big takeaways from the crisis is that we have used a lot of methods to supposedly address risk. You said the banks are safer now, right? But we don't need to make them islands. We don't need to isolate them. We simply need to make sure that they're not committing acts of fraud such that you get a big market break, a surprise, right? When the investors discover what they didn't know. That's the definition of a systemic event. And instead, we've turned these banks into islands and said, well, you have to fund yourself for 2 years when the world is ending. That's not a very practical policy objective, but that's essentially what we're doing today. It's funny, a very senior banker I know, I saw a couple months ago, he said to me, Chris, we've forgotten why we have a Fed. The Fed was supposed to be there to lend on good collateral. Now, they couldn't lend on Lehman Brothers, they couldn't lend on AIG because it wasn't good collateral. Nobody knew what it was. But I think in general, we've gone a little bit too far in constraining the ability of banks to take risk, make business loans. I'll give you a great example, lending on dirt for construction and development for single-family homes. This has just about been zeroed out. Banks don't want to do that. They do multifamily luxury development, sure. There was a lot of demand for that. Now we have too much. We have an asset over-allocation problem. But as far as single-family homes, we have a supply problem. None of the banks want to lend on that kind of asset. And I think we have to kind of rebalance so that policy is reasonable but not exuberant. Okay? During the exuberant period, 04-05, we did $4 trillion worth of new loans. A lot of that was countrywide. Probably a quarter of that was countrywide financial. Today, we're going to do $1.5 trillion, which to me is too little. Somewhere around $2 trillion a year, I think we can do without destroying the world, right? And the question is, how do we tweak policy so that we can have that degree of credit creation and not have the wheels come off the cart? I think that's the real issue.
Isn't the theme now, I think, post-crisis is that, you can certainly talk about the quantity of lending, but just overall capital is going to be deployed less efficiently. And when you say the banks have become islands, they're really islands that are segregated by or defined by sort of the regulating authority, right? So,
yes.
If it's for example, if you have a international bank operating in the U.S. or some other country, they're going to want a subsidiary. They're going to want capital there that they can seize and take control of, and this is, in a global sense, very inefficient.
Well, yes, we still have national treatment. And the other key thing that you just mentioned is when you force a business out of a bank where they run at 15-to-1 or higher leverage, and you instead say, no, we want non-banks to do this business at 2 or 3 times leverage, you're going to get less growth, much less credit creation. Every time there's an increase in demand for mortgages now, most of the non-bank financial companies that have moved into that sector since 2008 don't have the balance sheet to really respond. Ultimately, they have to fund off banks. Banks have a monopoly control of short-term finance in the U.S. for a lot of reasons we can't get into now. So to me, you almost know out of the gate that you're going to have less growth, less job creation, simply because you have less leverage in the system. And they tend to be much more conservative in the way they have to operate. And that's just part and parcel of the changes that have occurred. So, you're right, but it's funny. It's almost, again, as though we never sit down with members of Congress, with policymakers, and say, okay, what do you want? Because, a lot of this is politics. The policymakers are out punishing banks. They make great headlines. Whether you're talking about Elizabeth Warren or Teddy Roosevelt, they both had the same perspective, which is it's good to attack banks. Everybody hates them. But you need banks for growth. And if you look at the smaller institutions that we work with, they're the only part of the industry that's growing. It's about 10% of the total balance sheet because, most of the assets are concentrated in the top 25 banks. But these little guys are growing at much higher rates and they have much better margins than the larger banks do. So, it's a tale of two cities, really.
Okay, actually, I want to spend some time on those because that is one of your specialties. But just getting back to the big banks for a second, they're reluctant to loan at times, and I see a lot of criticism, especially coming from the government and also people who feel that they're being deprived of this credit. But at the same time, I think it was Sam Zell on CNBC recently, and he was talking about real estate developers. And he said that they just develop whenever that they have access to money. So,
yes.
The banks are sort of acting like the adult in the room here. Are we being too hard on them?
Well, to some degree. They're certainly the most conservative source of credit for most of the sectors they face now. And you're right. If you look at the commercial loans on the books of U.S. banks, they're going to tend to be pretty high quality. The lower quality stuff is what gets sliced up and sold into the securitization market. And my colleagues here at Kroll, one of our strongest area is not only rating new deals, but we have a surveillance product that follows all of these deals, the tenants and the assets and everything else. It's a very big market. And I think that, yes, you're right. I mean, right now, we're at the end of a cycle in commercial. If you think back to 2008 and some of the events before that, we put in place tax credits. Then you had the Fed with quantitative easing, manipulating credit spreads. So we had an enormous boom in commercial real estate and multifamily real estate. The recovery in single-family homes was more of a bounce. We had kind of traded off in 2012. You had a little bounce after the crisis, but then it came back because there's a natural demand for homes, and we don't have a lot of supply. We're doing less than 1 million new housing starts a year. That's not even close to the long-term average. So there's a lot of pent-up demand there. And I think that what you're going to see in the next couple of years is that commercial is going to slow down, especially the luxury assets, stuff here in New York City, for example. Not so much Chicago, where Sam Zell is, but if you look out on the West Coast, if you look in Florida, multifamily down in the bottom third of the state, all of these markets are pretty overheated. They had a domestic component, they had a foreign component that was coming in and buying assets for cash. But now I think you're going to see that slow down because we have oversupply. It's funny, there's a pendulum kind of between residential assets on the one hand and commercial assets on the other. If you go back over 20, 30 years, you'll see they kind of swing in and out of favor with investors. And, for the past couple of years, there was a very strong bid from investors, insurance companies, pension funds. They all wanted to invest in commercial real estate because it's properly seen as a very solid sector. But you can have oversupply, and if you talk to people in the luxury market in New York City today, they're having to fight for rents. The rental guys are really having to hustle because if you have an older building, I live in an older building up near Central Park, you're competing with new. And the new stuff, by the way, is being built at $4,000 and $5,000 a square foot to acquire and build. It's it's very toppy, but we always say that. 20 years ago, the older developers would have been complaining about the new money coming in and bidding up prices, but then those prices ended up being validated over 10, 20 years.
Yeah. Now, with regards to residential real estate, say, I think when the market turns, it turns kind of like a wave, or like if you imagine like a long ribbon or tape, and you flip one side and it ripples through.
I mean, yeah. I'm an advisor to a little company called Weiss Residential Research. Alan Weiss was one of the founders of Case-Shiller. And what he's done is taken that original model and gone down to the asset level. So instead of showing you an average for a zip code, he can show you individual houses. And what you see in neighborhoods is that when prices start to turn, the canaries, if you will, in the coal mine are the least attractive assets. So those are the houses that are difficult to sell, difficult to lease for rental, right? Those are the ones who start turning. Right now, about 40% of the U.S. market's actually going down, even though the averages that you see at the national level and the MSA level in different cities, those are all still positive. So we think of it as a school of fish. It usually takes months to turn. But when you do see a turn, for whatever reason, it can be quite significant. Now, I don't think we're going to see a huge decline in residential home prices in the more affluent areas that have been dragging the averages up. But what's interesting is that we haven't seen the recovery in the secondary and the tertiary markets, the middle of the country, the Inland Empire in California, right? Central and northern Florida. No, you haven't. It's only been in the really attractive areas that you saw money come back in. Because again, going back to what we were saying about the banks, everybody's credit averse. They don't want to take risk. So they figure if they're going after that top quality asset, they're going to have less probability of default. And you see this with the big banks. More than half of their production of the top 4 banks are jumbo loans that they can't sell into the agency market. And by definition, those are people with very good credit.
Right.
But the bottom third, if you're in that 650, 620 FICO level, it's going to be very hard for you to get a loan. Almost impossible.
Right. And that is the big catch, right? When we see these low interest rates.
Well, that's where the numbers are.
Yeah.
If you want the economy to grow, you got to make it possible for somebody to make a reasonable loan to a family who may have beat up credit or they had some issue, right? But if they all have jobs, there's got to be a way to help them. That's the real conundrum, I think, for policymakers. How do we balance this market so it's not overly exuberant such that it blows up, but we're not cutting people out of the market who should have access to credit?
Well, certainly this foreign money coming in is not helping, right? Because one of the solutions to the problem that you outline is just lower home prices.
Well, look, globalization is a two-edged sword. On the one hand, it's great. If you have cheap goods coming into the country, it's easier for people to satisfy their wants and needs. But on the other hand, if you have people who are running out of other countries because of problems there, and they have access to foreign exchange, and they could just show up here without having to go through any of the procedures for anti-money laundering and just buy substantial assets, you're going to see price increases, and that's what we've seen.
Is that over for now?
I think it's slowed down a little bit. If you look at the data from the National Association of Realtors, it's still pretty strong. I think it's marginal in areas like California, Florida, Texas. You have a very high percentage of foreign buyers. These are, even if there's no income from the asset, they're just parking money in dollars that's safe in a jurisdiction that still protects property rights. I mean, that's the biggest reason why the U.S., in our view anyway, here at Kroll, is a AAA. In relative terms, it is the best credit in the world. And if you're looking at their own debt in dollars, how could you come away with a different conclusion?
Yeah, no, I tend to agree with that. Let's wrap up big banks before we move on to the regionals. What do you think is a long-term reasonable target expectation, say, for return on equity for these big universal banks? You see the capital requirements going up. You see like GE, for example, exiting this area because they can get far higher return in the industrials. What is a reasonable return on equity?
Well, I mean, in terms of the ongoing business, you're probably looking at something in high single digits, maybe low double digits. If you look at a U.S. Bank Corp, which is the best managed of the top 5 commercial banks, trades at 2% or 2 times book value. Getting in the low teens is possible for them if you keep your efficiency under control. And it's a lot about cost cutting here, because you don't have a lot of lift on the top line. So you're looking at efficiency. That's the most important ratio for any bank right now. And I think, the banks that are more transactional, Goldman, Morgan Stanley, the rest of them, they'll have more variability in their revenues. But again, they can't play for their own account the way they've done in the past. Investment banking has been relatively weak. Capital markets, relatively weak. Now, some of them have turned in asset managers, Morgan Stanley, UBS. There's a number of others that are focused on that, but there's not a lot of alpha in that model. That's pretty much of a utility model, should be very steady if they, again, keep their costs under control.
When you say things like efficiency and cost control, that is sort of a short-term game, right? I mean, there's not a lot of long-term potential in that.
They have squeezed a lot of the savings out already. And one of the things that the street doesn't understand is when you've had a long period of low rates like this, even if rates were to go up, and I'm not convinced that they are anytime soon, the benefit for big banks is going to come very slowly, because they still have to reprice their balance sheet, which will take years. The average life of a big bank balance sheet is about 5 years. So you figure 20% of their assets redeem every year. They have to replace them, and then they also want to grow their book. And U.S. banks have been lending more money. If you look at the number of loans versus deposits and capital, it has been growing. But again, very conservative. I mean, default rates are at the lows for the last 20, 30 years.
Okay. And given what you just said, sort of I guess the inertial factor of the balance sheet, if the Fed did start to raise interest rates, there would have to be some credibility behind it to tell people that they're not going to just about face right away for any of that to be priced into bank stocks, don't you think?
Well, of course. I mean, if you look at where the market, to the extent we have a market for Fed funds is, and then you look at the rate that the Fed is paying on both required and excess reserves, that reserve rate is a floor. It essentially says to little banks who tend to be sellers of funds, you can earn half a point at the Fed, right? Now, having said all that, even if they raise the benchmark again, and there's some market volatility as a result, you see some volatility in spreads, I think this market would rally. after. I think you'd see the 10-year go down and test the lows again, simply because the starvation, the financial repression in terms of available investment opportunities, both for banks and for everybody else, is so intense that I just don't see how you could see market rates go up in the near term. Until we get the central banks away from this negative rate madness and realize that if you manipulate asset prices but you don't make income go up, you have a problem. Because when you stop doing what you're doing, the asset prices will revert back to the mean. It's basic economics. They were hoping that by starving the markets for duration, investors would take more risk. And you've seen that to some degree, but pension funds, insurance companies, they are very limited in what they can buy. Banks, same thing. They have an advantage of leverage. I'll give you an example. A bank can buy $5 worth of Ginnie Maes and pyramid them and repo them out versus $1 worth of commercial loans. Because the commercial loans have a 100% risk weight. The Ginnie Maes have a 20% risk weight. So in many respects, owning that risk-free government asset is a better choice for the bank than making a loan. But they're so hungry for duration now, they're making loans. C&I credit, small commercial real estate, owner-occupied assets, that's the bread and butter for smaller banks. That's really their sweet spot. And most of them are staying away from residential lending. Very telling. They just see no good risk-return trade-off there.
Okay. Let's talk just a few minutes about these regional banks, and let's focus on down here. I'm in Houston, Oklahoma, that area with what's going on in oil. I know you've talked about these banks before. What's your general perspective on these? Is there trouble hiding, lurking in there somewhere?
Well, no, again, this goes back to credit conditions. What you've seen is, yes, there have been a lot of bankruptcies in the oil sector. The banks in our rated universe have done pretty well, though. We have some specialty lenders like Cadence, for example, which was started to focus on lending. A lot of bankers that came from Zions, from their Amegy unit, which was a lending specialization shop that was really focused on energy. And they've done pretty well as a group. And part of the reason is when the bankers are talking to these companies, say they have private equity, right? They want to see more cash if they're going to continue to advance loans. Because, obviously the value of the reserves has come down. There's other things going on. We've also done an awful lot of private ratings in the energy sector and the transportation space that's related to energy. So, the credit conditions aren't horrible. They're bad. We have had to see some shops be restructured. But what's surprising is the vulture funds have been coming in and buying these assets pretty aggressively. So that there is equity funding there. There's also debt funding in the high yield market. And I think people are trying to figure out what's the game, what's the time frame for energy prices to get above $50 and stay there, right? Because then they can start to construct a model that makes that work. You've also seen a continual advance in terms of efficiency on the part of a lot of these energy companies. So whereas they might not have worked 2 and 3 years ago, they work today. It's remarkable. So overall, I'd say the industry, even though you saw an uptick in defaults this year, largely from energy, the industry's handled it pretty well.
Okay, can they continue to handle it well if oil prices stay where they are right now?
I would say for the smaller institutions, yes. They tend to be much better underwriters of credit. They're much closer to their customers. Their customers are small. The larger shops, we'll see, because they tend to make bigger bets. They have to. And there's a tendency in energy lending to forbear and to give the customer some time because they don't want the assets. The last thing they want is a bunch of oil, rigs. No. The bank has an incentive to work with the customer as long as they can see the equity. And that's the key thing. If the customer is able to raise new money and make sure that the bank is good, because the regulators are watching this very closely. If the regulators see a credit that doesn't have a floor underneath it in terms of equity, then they're going to pull the plug. So the banker has got a very strong incentive to work with the customer, but they also have to make sure that the numbers work. And that's basic, debt equity leverage, that sort of thing, cash flow. And the banks large and small are very focused on this. But what's funny is that the real pain in energy was felt by bond investors, private investors who had gotten into the space when prices were over $100. And they're still there. I mean, they've kind of got wiped out. Now you got another wave of equity coming back in.
Okay, I know we're running out of time, Chris, but I want to get your thoughts on, I guess, putting what we're experiencing now in historical context. You have a really strong grasp of history, which is unusual, I think. And I heard you say something once that I thought was interesting. It was just a passing comment, but you said something like, we can't afford, what did you say, to continue to allow China to get rich at our expense, or something like that. And if that was coming from, say, a politician, I would say, okay, this is someone who's just trying to scapegoat, lay our problems off on someone else. But I know you're not trying to do that. So I watched it again, and I'm thinking that, do you see China as maybe the bartender that's getting rich off the drunk?
Well, I mean, yes and no. China, I read Chinese history as an undergrad with one of the great researchers at Villanova, Cornelius Kiley. And, China has been through a very difficult period of war and colonialism and everything else. And in the 20th century, they have tried to catch up in, years, developing capital and accumulating capital that the U.S. was able to, gather over a century. When we took the baton from the Europeans during World War I. That's really when you saw the ascendance of the United States as a really strong economy and as a provider of credit to other nations. So, in the most recent period, China's obviously had a mercantilist model. We're going to sell stuff to the rest of the world and not buy so much stuff from them, right? Very simple. And I guess, my instinct is always to be a free trader. But I also think that you have to appreciate that all of the Asian economies, not just China, they basically are in a mercantilist model that has a very strong government component. Look at Korea. I mean, they subsidize their manufacturers in all of these markets. I'm getting ready to put out my book on autos. There's a completely irrational market where nobody makes their cost of capital. I mean, they all want to have a car industry, right? But my God, if you look at the numbers and really look at the returns, they're not there. So I think that, the overcapacity that is really the context for this whole conversation almost forces a China to try and target foreign markets, try and target foreign investments so that they could try and create the next phase, right? Which is, can we have enough domestic demand so that we are not completely dependent on foreign demand for growth, for jobs, and everything else? And it's a difficult challenge they face. The U.S., as I say, we had the luxury of industrialization when the rest of the world was destroying themselves. And then we rebuilt the world after World War II with a lot of credit and a lot of loans that were later forgiven. It was just cash, right? And that's why the world enjoyed such enormous growth. But today, population growth in the U.S. is 0.5 instead of 1.5 after the war. So it's harder to get more growth. And the Chinese face the same problem. Their own approach to demographics, the one-child policy and everything else, makes managing their situation very difficult, too. Because think about it. In China, if you want an outlet, you have real estate, you do let money out of the country. If you're a cadre, you can get access to foreign exchange. And that's pretty much it. The rest of the economy is largely state-dominated. So, I think you shouldn't overdo the protectionist element of this. I think you just need a balanced approach, because I always remember my good friend Fritz Hollings, the former senator from South Carolina. And he said, "Christopher, could I survive on 3 bowls of rice a day?" And I said, "Probably not, Fritz." And, he was just stating the obvious, which is that people in the United States have been forced to compete with workers offshore who will work for a tenth or less. And that's a difficult thing to do. That's why you have flat income growth in this country, is I think because of globalization.
I want to get your thoughts on something else. I reviewed many of your talks over the years, Chris, in preparation for this. And most people, I don't think, especially people on the mainstream circuit, don't stand up well when you do that. But you said some really interesting things way back. And one of the things you said, I think this was in 2010, you said, watch for sort of a nationalist movement. Watch for this. And, I was still recovering from my George Bush hangover, and here you are sort of anticipating Donald Trump in 2010. What made you what led you to that? And clearly you've been right. What are your thoughts going forward? Is this going to be realized? Are we going to be moving more in that direction?
Well, it goes back to history. History never repeats itself exactly. But if you look at the 20s after World War I, the U.S. economy had been flat. The farm sector had gone through terrible deflation. You also had a lot of innovation, electricity, other forms of energy, which radically changed many industries. And again, you started seeing overcapacity. You also saw inflation. Back in World War I, inflation was a big issue in the United States, down at the local street level. And I think today the same sort of situation holds true. Flat income growth, tough economic environment, and that lends itself to more populist political outcomes. So, you saw Brexit. Wall Street, most of the elite opinion leaders went into that event thinking that Brexit would fail. And I don't think they read the tea leaves correctly. Likewise with our election. Do most of the supporters of Donald Trump answer the phone when a polling organization calls? I'm not sure. But what you can be sure of is that his base of support among lower income Americans, which is quite impressive, is partly a result of the disenfranchisement and the alienation that they feel because of the economic situation. Right or wrong. I think we make too much, as I said before, about trade issues and protectionist issues. We want to be open. It makes us more competitive. But at the same time, it may not be easy to see the gains in productivity and the other indicators that you measure an economy's health. And today, because so much of the gains in the past were so dramatic, the microchips, all the rest of it, how do we go forward with that? And so I think, the basic problem is that when people feel constrained and uncertain, it's easier for a populist political candidate to get their support.
Chris, I know we're running long here. Do you have time for two more questions?
Yeah, sure, go ahead.
Okay. I want to get your thoughts on, I guess, the future and how China is going to fit in to the world. You see, for example, the currency sort of being normalized into the system. You see, obviously, significant contributions to the economy. Is this analogous to the handoff we saw between Britain and the U.S. Back at one time where, there was war involved and a very tough time for Great Britain, and we saw the pound taking a beating. But is this analogous to what's going on now where there's going to be kind of a soft handoff of dominance between the U.S. and China, kind of playing a shared role, I guess, in the future?
Mm-hmm. Well, interestingly, we had this same conversation about Japan 20 years ago. Everybody was concerned about them buying the world. And, the Asian economies, again, because of the mercantilist model, have been very good at accumulating reserves. And, it kind of looks like savings from a distance. But the difference is that the U.S. economy has far more leverage in a financial sense. You get a lot more growth for the dollar of input. And I don't see any country in the world with the combination of opportunity, protection for private property, some large degree of confidentiality for private business transactions. All of those factors which go into, ultimately how you assess the U.S. as a credit are pretty difficult to compete with. There's really no other nation in the world that has that degree of openness. So I think China is clearly going to play in a very big way on the global stage. The challenge they face is, can they allow their people to be free enough to be prosperous, given the imperative of maintaining the control of the party? I always remember the second sentence. It's not just about, power comes from the barrel of the gun, but the party must never be subject to the gun, okay? And that's the key part of that quote, which of course everyone forgets, But I think that, going back to your first comment about the Orwell quote, the thing that he reacted against wasn't communism or socialism. That wasn't the point of Animal Farm. The point of Animal Farm was a refutation of Stalinist communism, the authoritarian aspects of it. Because George Orwell was a socialist all his life and a very, diehard member of the Labor Party. But, I think he was really criticizing the authoritarian extreme aspects of Stalinism. And I think, China under Xi has the same problem. They got to figure out a way of diversifying power and letting go a little bit. And then I think China can grow at least as well as the United States. But it's that necessary condition, protection for property rights, not having the party trump the courts when it comes to basic issues of policy and day-to-day commerce. Those are the things that people look for in a sovereign. And if China doesn't have that, then you know what? They're barely an investment-grade credit. Think about that. Those qualitative aspects for investors are the most important. That's why people are still shy about Russia.
Who else did you have in mind? I'm guessing it's one of these big common law jurisdictions like the UK, Singapore, or Hong Kong. When you said the US only has one competitor in this regard, who were you thinking about?
Well, I don't know that they have any competitors. I mean, the UK has an admirable commercial culture and protection for private property. And I think it's certainly comparable to the U.S. It has a lot of common antecedents. Obviously, we take many of our examples from UK history. But I don't know that there's any real competitor to the U.S. I mean, Australia is a very open and free society. A lot of investors love it. And there are other jurisdictions, Singapore. But each one of these has little nuances, whereas the U.S. is kind of the Wild West. You can hide here. I mean, if you're a private Chinese investor, you can go buy real estate in the U.S., and if you do everything right and pay your taxes, you have no problems. You can just disappear. And I think that ultimately is what attracts foreign investors. I mean, look at the amount of money that's flowing into this country now.
Yeah, it's incredible. Okay, and then just to finish off, I want to get some predictions for you, or just a vision. When I think about 2008 and that whole thing, sort of the lasting image I have of that, and unfortunately these things often are shaped by Hollywood, actually, with the Big Short and movies like that. But the lasting vision I have, or memory I have, is Hank Paulson going to Congress and saying, you can't give me a squirt gun, you got to give me a bazooka, and then I won't have to use it. Then turning around right away, using it. 10 days later, just giving it to the banks. That is sort of the lasting impression. And like you said in other interviews, that's been a real burden. I mean, things are not the same. You can't just pay off the debts and go on like you were before because of that lasting image that we have of them getting bailed out. When this all comes and we have to pay the piper, something is going to happen again. What do you think the lasting image is going to be? How are we going to get out of whatever it is that happens, and what are people going to remember about it?
Well, I am not an apocalyptic sort of guy, despite my somewhat bearish tendencies. I think the real threat is that we could just muddle along and have very low growth, and that has political consequences, which I think are more of a concern than the financial consequence. We've largely shut down the growth engine in the U.S. Because of overregulation, and hopefully once we get through this election, we can have a conversation about rebalancing things. But I am not looking for another market break, not at all. I think, if anything, regulation is going to put certain industries out of business, like the mortgage industry, and especially the servicing business, and eventually we'll have to fix it. I mean, there'll be no choice. But I don't see any market break coming at us per se. The only last thing I would mention, though, is that when the central banks stop with their intervention, you're going to have to rebalance valuations, especially equity market valuations, because we've been taking duration out of the bond market, so people have had to buy stocks. Very simple. Once you stop the big intervention, and this includes reinvestment by the Fed, and you have more opportunities in the fixed income market, I think that may affect valuations for equities, simply because income levels and revenue growth levels are pretty tame in most industries. Look at autos. Autos had a tremendous run over the last 5-6 years in terms of sales, credit availability, all the rest of it. And now it seems like the industry is cooling off, and we may have seen the peak in the last year or so.
So I think what you're saying is that we can have a big reset in valuations, both in the stock and bond markets, with sort of populist political consequences, but not sort of the domino effect in the financial markets that we faced.
Well, I don't know that the short-term moves in the financial market aren't going to directly impact politics, because most Americans are not involved in the financial markets. The participation of average investors is lower than it's been in a long time, and that's a concern as well. I'm just saying, if you have a mix of policy that doesn't allow for reasonable credit creation and reasonable levels of growth, then it's going to be hard to satisfy everybody's wants and needs. If you tell everybody that, population growth is 0.5%, therefore we're going to have 1% GDP growth forever. Believe me, that's not going to be a welcome message. That message in many sectors, especially real estate, is going to be rejected out of hand because Americans want to run faster. The question is, can we do that without blowing up again?
Right.
Anyway, thank you so much. I appreciate your time.
No problem. My guest has been Christopher Whalen. Please check out his company website at KrollBondRatings.com. He has a personal website as well with all of links to all of his appearances at rcwhalen.com, and he's very active on Twitter as well at rcwhalen. Chris, I could keep stoking this fire forever, but I'm not going to. I appreciate your time, and I hope to talk to you again when the book comes out.
Oh, yes, please. Thank you very much.
Thank you very much. And don't forget to check with powerandmarket.com for insightful interviews with the world's leading experts in economics, investments, and finance. Till next time, take care. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.